Hi, today's session is on joint cost allocation, a very important topic. Uh, Chances of being asked in essay questions, and if not, you will have enough questions in MCQs. Let us discuss in detail about what is joint cost, what are joint products, what are byproducts, what is the treatment of byproduct, and how the treatment of byproduct will have an impact on the joint products. Before that, we'll learn some basic definitions. Joint production process. Joint production process means two or more products are produced in a joint operation. Say for example, this is a joint operation. From this joint operation, we identified that we received two different products. Until you identify here, they were produced in a joint operation, like diesel, petrol. We extracted diesel and petrol in a single format here. After you extracted, you identified that this is diesel and this is petrol. So the operation what we have here, like geological survey, digging, or rigging, okay, in the sea to extract the oil products. This and all is a joint production process. Like some operations, what happens is we spend common raw material, common labor in the joint operation, and we identify here this point. This is called split up point. We identify and we separate the products. But before the identification, they were all together. Then after the identification, they become main products. So this is what we are going to discuss. And the joint production process means during this process, we don't know which products and how many units we are going to receive. Joint products are those which are intentionally produced. Joint products are those which are intentionally produced. So in a joint production process, you incur joint cost here, and you have an identification point which is called a split up point. And at this point, when you identify, you separate them as different products. Like this is A and this is B. Now I call them as joint product B, joint product A. These are the main products which are intentionally produced, but before they were identified, they were in joint process, joint production process. We spent lot of material here, lot of labor here. Now the question is, how much of this cost should go to JPA and JPB? And this is what our topic is. Okay, so the allocation of joint cost is our topic today. During this operation, we may get some product which is not intentionally produced, which is called byproduct. Say for example, we received a product called C. Our intention is not to produce C, but A and B. In the normal production process, there is another product derived which is called C, and we call it as byproduct. Why, when and what helps you to identify a product as joint product or byproduct? Okay, all are from the joint operation, but why do you call these products as joint products and this product as byproduct? Just very simple, to identify that what is the selling price of byproduct. Okay, say $2. What is a byproduct of this A and B? Say $50, say $120. You can compare now the sale price. We do not intentionally buy or produce this product here when the other products are selling at 50 and 120. So you need to classify the products derived from the joint operation as joint products and byproducts. based on their selling prices. The byproduct selling price is much lower as compared to the sale price of joint products. This is where you can identify a product as byproduct or joint product. Sales price is much lower as compared to the sale price of joint products. The joint products are also called as main products because our intention was to produce main products, but during the production process, some products will also be derived which have very little sales value as compared to the joint products. Therefore, we call them as byproducts. The point at which I've been telling you that the point at which we identify the products from the joint operation. Joint operation is this, and here we identify that we received petrol, we received diesel. Okay, so we received 100 gallons of petrol, 100 gallons of 50 gallons of diesel. So this is called identification point, which is also known as split-off point. Split-off point is the point at which the joint products from the joint production process are identified and separated. These were together here. And we identified and separated them. Okay, that's called split-off point. And now the question is, we have a joint cost of, say for example, $50,000 incurred before we know that we are going to receive A, how many units, B, how many units here. We produced, say, joint product A, joint product B, 5,000 kgs, 5,000 kgs, and B 15,000 kgs. This is the weight, or liters or meters, etc. Now, how to allocate this joint cost to the joint products? This is what our topic in fact. For this, we have certain methods. One of the methods is physical units method or physical quantity method. Physical quantity method uses the physical quantities as ratio for the allocation of joint cost. So here joint cost is 50,000, which should be allocated to the joint products A and B. What is the method? Physical units method. Physical units method, 5,000 is to 15,000. Okay, the total is 20. 5 plus 15. So joint cost of A equals to $50,000 times 5 divided by 20, and joint cost of B equals to 50,000 times 15 over 20. Okay, so you should calculate. Very easy method. It simply uses the physical quantities as ratio. Okay, physical quantities ratio we should use to get the joint cost allocation to the joint products. The second method is NRV method. What is NRV first of all? Let me give you the graphical presentation. This is joint cost, split-off point. The products are identified, and here these products is joint product A, joint product B. We can sell this unit at $15 per unit. We can sell B at the rate of 20 per unit. I mean to say, we have a customer ready at a split-off point itself. But your marketing team says that if you further process it, if it is a leather product, say for example, you need to do some designing. You have a blazer, you have a leather coat, but you need to have some stickering on it or some design. Then it can be sold at a higher price. It's a leather bag, or it's a shirt with embroidery, can fetch you higher price. So your marketing and sales team may tell you that, sir, we will further process it and we'll sell at say $25. To further process, how much is cost incurred? Say for example, we incurred $3. Okay, it's a good idea. What is that? You are selling at $15 at a split off point with no further operations. But if you additionally process it by spending $3, you will be able to sell at 25. So you need to have a cost benefit analysis that our $25 we are getting after further processing, but we used to get $15 before further processing. Therefore, the additional benefit is $10. But to get additional, benefit of $10, we need to spend additional cost of $3. So the net benefit will be $7. So as long as net benefit is positive, you can go ahead with this. Okay, if your net benefit is positive, you can go ahead because it is fetching you some additional profit. Say let me test on this B also. Say we are further processing it and we are selling at $35. Okay, but to further process, say for example, we have to spend $18. What is the selling price here? $35. What was the selling price at split off point? $20. What is the benefit you are getting? Additional benefit $15. But to get additional benefit of $15, how much you have to spend? $18. So it is giving you a net benefit of negative amount of $3 of no use. So this product can be sold at a split off point itself. Okay. So what I mean to say is whether a product is to be further processed and sold or it has to be sold at a split off point, you need to conduct a cost benefit analysis. Cost benefit analysis in which you should see what is the additional cost incurred and what is the additional benefit you are receiving, whether net benefit exists or not. A product has to be further processed only when there is a net benefit. Okay, yes, say for example it is not $18, it is $8. What is the additional benefit you are getting? $15. What is the additional cost you are incurring? $8. So you are going to have a net benefit of $7. Go ahead. Product B can also be further processed because 35 minus 20, $15 is the additional benefit. To have the additional benefit, we are spending $8. So there is a net benefit of $7. We can further process it. Now in this example, we are selling at 25 means we are not getting this, isn't it? Okay. And how to allocate this joint cost to product A, product B? Using net realizable value method. Net realizable value means the gross sales price, but this sales price you will get only after spending this money, selling expenses or further processing expenses, and this one you spend for say 5,000 kgs and here it is 15,000 kgs multiplied by 5,000. This is the NRV of joint product A. $25 gross sales price minus further processing cost into the quantity. So here 22 times 3, 66. 25 minus 3 into it is $110,000. Likewise B, 35 minus 8 into how many units? 15,000 units. 15,000 units equals to 33 times 15,000, 495. So NRV ratio here, NRV ratio A is to B equals to 110. I just removed this resource and 495. So total 110 plus 495, 605. So this joint cost to be allocated using this ratio. So this joint cost is, say for example, $65,000. $65,000 into 110 over 605. $65,000 into 495 divided by 605. So this is called NRV. Always remember, please, when you calculate NRV per unit, you should multiply. Otherwise, what happens, if you just calculate NRV, it will be 22 is to 25 minus 3 and 35 minus 8, that is 27. Where is 22 is to 27? Where is 110 is to 495? You may have answer from the answers given. You may have answer if you calculate per unit NRV. Please do not calculate per unit, because here if you produce 5,000 here, you are producing 15,000 here. So your NRV will be much higher. Okay, here see NRV is much nearer 22, 27, but NRV almost it's a more than 4 times. Always multiply the quantity with the NRV per unit. NRV per unit. NRV equals to sales price minus selling expenses or further processing expenses, multiplied by the quantity. That's very important. Net realizable value method. Okay, relative sales value method, the final sales value, we'll discuss that. Now joint cost, we know. Split of point. Separable cost, this has many names. Like we are selling at $15, but if you spend another $3, we can sell it for, say for example, $20. So we need to check what is the cost we are incurring here. This is called further processing cost, additional processing cost, okay, additional cost, or also called as separable cost. So you need to be careful about using the terminology. This is a graphical presentation to make you understand well, to know about all the terms used in a joint cost and joint cost allocation. You have an input. See, we have spent lots of money without knowing which product is coming in which quantities. It's called joint production process. In this process, you have spent lots of amount, that's called joint cost. And we have a point where we can identify the products, which is called split off point. And once we reach a split off point, you identify and separate the products. We received 3 products here: oil, gasoline, and chemicals. And on these we spent collectively here, which is called joint cost. Now you have some bottling or canning of this, the liquid formats. So separate processing cost. Or gasoline may be sold here, is not further processed. So your gross sales value here. Okay, but this product is not further processed, no more here. Okay, it is sold at split off point itself. Okay, it's not mandatory that all the units are to be further processed and sold. Okay, there should be a benefit. If there is a customer ready here which is highly beneficial than further processing, of course we can sell it split off point itself. Now we have outputs with a positive sales value, with outputs with a 0 sales value. What is that? Some products may have output with a 0 sales value from the byproducts. Let me show you the byproduct treatment. Say for example, in a joint operation, you also get a product called byproduct. Say for example C. Now we have 2 main products, A and B. Now we should see that whether this output has a separate definite sale value or not. Once in a blue moon, a customer comes and lifts all the byproduct at an agreed price. That will go to miscellaneous income. But if there is a customer who comes and picks up at a price like 1,000 units on an average you receive every month, and it can be sold at the rate of $2. This need to be inventoried, and we make a person responsible for the sale of this money, and we spent, say for example, $92,000 here. When we are sure that the byproduct can be sold, it must be inventoried. Inventoried means it has to be taken into stock account. There will be a stock creation as product C with 1000 units, and you are selling at $2. Now what you need to do is, before you think of allocating this method using physical quantity method, NRV method, or gross sales value method, you should first of all find out a net joint cost. Okay, so what happens here? Byproduct is inventoried. When byproduct is inventoried, the sale proceeds of byproduct should be reduced from joint cost and find out net joint cost. This is called net joint cost. And from net joint cost, this is the amount you should charge it to A and B using any method. First, you need to do this homework, like whether byproduct is inventoried or not. Inventoried means stock taken into stock item or not. Once the byproduct is inventoried, you should find out net joint cost by deducting the sale proceeds of byproduct. Then use the methods given in the question to charge it to product A and product B, which is very, very important. You need to see the treatment of byproduct. Okay, these are all some examples of split of point expenses and what products we receive. This is a joint cost and a joint product. We may receive a byproduct. Then there will be a question that whether it can be further processed or not. Okay, whether it can be further processed or not, and what is the treatment of byproduct. Sometimes if joint products do not have the saleable value at a split off point, they may have to be further processed and sold at a final price. Now, allocating, reasons for allocation of the joint cost. One is the gap requirement. That gap asks that how do you calculate the cost of the products. So you need to show them that these products are derived from joint operations wherein we spend this much money and we allocated using these methods. Then gap says you should not allow physical quantities method. Okay, so physical quantity method is not allowed for external reporting purpose, that you must know. And not only that, we must know what is the total cost of product A, product B, which are received jointly from the joint operation. Okay, and also division wise profit analysis. A joint product A or manager is different from joint product B, so we need to have the cost control and profit analysis from two products. Sometimes we may have the customer ordered goods, and we need to give them the quotation that this is the price of the goods. So in that case, cost based pricing contract. Any loss is there to claim from the insurance company, we must know the product cost and fixing the selling prices purpose. Now the methods, in fact we have two methods. One is physical quantity method, and next one is market based method. In market based method we have three methods: sales valued split off point method, NRV, constant gross margin method. Okay, constant gross margin method. So in fact we can say that we have four methods better: 1, 2, 3, and physical quantity method. 1, 2, 3, 4. Okay, but this is based on the market based, in a sense, dollar amount. This is not a dollar amount: kgs, liters, meters, gallons, barrels, etc., etc. And one important point about physical quantity method is that it is not allowed as per gap for external reporting purpose. Okay, so the four methods, not to mention like a second method, then three methods and all. Four method: physical measure method, not allowed as per gap for external reporting. Internal reporting purpose we can use it: NRV, sales value at split off point method, and percentage gross margin method. Okay, then two methods for accounting byproducts I gave you here, which I already explained you, that if a byproduct is inventoried, the sale value of byproduct should be deducted. Sale value of byproduct, say we received byproduct C Okay, 1500, and this is at the rate sold at the rate of 3. If at all you are spending some money to sell them off, you should deduct them, and only this amount should be multiplied. 1500 into 2, $3,000 you need to deduct from this $92,000. The joint cost is 92,000, say for example. So if there is any selling expense of byproduct, still you need to deduct that. Only net amount you should deduct from joint cost. Okay. Joint cost, relative sales volume or physical measure method, okay, all are same, and as you know that this is not allowed as per the gap. Let me give an example here on physical measure method. Here we received gallons 25,000 in the case of cream, and 75,000 in the case of skim. So here the joint cost incurred was 400,000. So this is the 400,000 in the joint operation received with no byproduct. Okay, this is cream and this is liquid. Cream we received 25,000 gallons, and the liquid we received 75,000 gallons. If this company uses physical measure method, so cream is to liquid equals to 25 is to 75, total is 4. Now joint cost of cream equals to, what is the joint cost here? 400,000 times 1 divided by 4, so 100,000. Joint cost of liquid equals to 400,000 times 3 over 4, 300,000. Just to cross check, if you take the total cost of these individual costs of these two, it will give you 400,000. Now if you want to calculate per unit value, again 100,000 divided by how many gallons you receive, 25,000, $4 per unit, and here 300,000 divided by 75 will give you $4 per unit. You can do that way. Okay, the method selection, that depending upon the information available, whether we should use a split of point method, net value, sales value at split of point method, NRV method, or or percentage gross margin method. In the exam, you are not allowed to select a method. You will be given a method, so no need to worry. The sell or further process, you need to use cost based benefit analysis, which I explained with example. Okay, sales value at split of point method. What important point here is that, again, as I told you, you need to take the quantities, not the sales prices. Say for example here, this is a joint cost, and you have two products here. A, you received 5,000. B, you received say 10,000. This can be sold at $3. This can be sold at $2, and you are not further processing. Say for example, you are not further processing, and the method says sales value at split of point. Do not consider 2:3. Please always remember, you should multiply with the respective quantities. So A is to B equals to 5,000 times $2 is to 10,000 is to $3. So this is going to be 10,000 and this is going to be 30,000. It should be like this. But see, if you take sales price ratio, it would have been 2:3, but now it has become 1:3. 2:3 is different from 1:3. Always remember, you should multiply with the quantities, not just the prices. So here joint cost, same example, joint cost is say 400,000, and sales price at split of point. What is the sales price at split of point? Sales price at split of point is for example 8 here, and 4 here. And how many gallons we are receiving? 25,000, 75,000. Remember one more point, how many units you sold, how many units their closing stock, not to be taken into account. Very, very important point to confuse you. Okay, you may be given that this many units are produced and these many units are sold, this is a closing stock. Why? We just want only the joint cost allocation. Why should we know this one? It's not required. You should always calculate how many units are produced. That is 25,000 is to $8 is to 25,000 units times 8 is to 75,000 times $4. Please do not consider how many units sold, how many units in the closing stock. We are allocating the cost, we are not allocating the selling expenses. We are allocating the cost, we are not allocating the selling expense. If you are allocating the selling expenses, that can be charged based on the sales, you can use 20,000, 30,000. That is different issue. But we are talking about how to allocate the joint cost. We should give importance to the production, not to the sales units. Okay, so if you are using selling price sales value at split of point method, you should take the quantity produced multiplied by the sale price at split of point. That ratio should be used to allocate the joint cost. Like this, you can go through the solution. NRV, as we know that NRV is the difference between final sales value and separable cost. You can sell at $5 here, but if you can further produce, you can further process, you can sell it for say for $15, getting a benefit of $10 by spending $4. So here NRV equals to 15 minus 4, $11. But do not take $11 as the ratio. No, into quantity. After you calculate NRV per unit, you should multiply with the quantity. Likewise, product B, you can sell it at $10. If you further process it by spending $2, you can sell it for $15. NRV of this product is 15 minus say 2 equals to 13 multiplied by its quantity. This is the ratio to be used to allocate joint costs. Like this. Percentage gross margin method. In the case of percentage gross margin method, what you need to do is you need to check first of all what is the total price. Let me give an example here. We spent say $90,000 here. This is a joint cost. Listen carefully. Say we do not have any byproduct. Now we received two main products, 2,000 and 3,000. This can be further processed, say for example, and we are selling at the rate of 75, and this is also further processed and we are selling at the rate of say 120. Now how do you calculate the joint cost of this 90,000 of A and of B? Step 1, what you need to know is the total sales value. Total sales value A, 75 times 2000. 75 times 2000 will give you 150,000. Okay. B, 120 times 3000, that is 360. 360,000. Okay. And to get this price, say for example you spent $5 here, you spent $10 here. Okay, less, this is second point, less separable costs, means additional costs. How much is that? A, 2000 into 5, 2000 times 5, that is $10,000. Total sales are 510 minus, we should deduct 10,000 of A, and B, $10 into 3, 30,000. Deduct 40,000 from here, you will get 470,000. 470,000. Third step is less joint cost. Joint cost, the total joint cost 90,000. 90,000. You will get a GP of 470,000 minus 90,000, 380,000. The fourth step is calculate percentage gross profit equals to GP over total sales times 100. Please note down this. So 380,000 divided by total sales 510,000 times 100. 380 over 510 times 100 will give you 74.5%. The gross profit percentage is 74.5%. And in the fifth step, what we need to do is we need to calculate individuals like A and B. What you need to do is first you take the sales of individual products, which we already calculated, 150,000 and 360,000. Less gross profit. Gross profit, you know that it is 74.5%. 150,000 times 74.5%, that is 111,750. Then it will give you total cost 38,250. This is the total cost. Likewise here also 360,000 times 74.5%, 268,200. Deduct it, you will get 91. 268,200. You will get 91,800. This is a total cost. See, total cost includes this 90,000 and this $5 and $10 on these amounts. So I know that what is the joint cost incurred, what is the further cost incurred on these products. Okay, what I don't know is how much of this 90,000 of A and B. So let me deduct this separable cost. So less separable cost. Separable cost already calculated here. 10,000, that is 5 into 2,000, and 10 into 3,000, 30,000 here. Okay, right. So 28,250. This total cost includes separable cost and joint cost, but joint cost is combinedly incurred. We don't know what is for A, what is for B. I'm just deducting to find out. 800, 61,800, and this one 28,250. This is your joint cost. Even if you class verify by taking this, approximately will get 90,000. 28,250 plus 61,800. This is 90,050. 90,000. This 50 is towards this some fractions here. I took round figure. Okay, so it is 90,000. Should calculate like this. Little lengthy calculation, but it's a fair calculation. Just you calculate total sales, deduct additional costs. Okay, you will get gross profit. Deduct joint cost, you will get gross profit. Calculate gross profit percentage. Remove gross profit from the final sales. You will get the total cost, which includes additional cost as well as joint cost. You know additional cost individually, so deduct them. You will get joint cost. Hi, welcome back. Now today this session is on overhead allocation. First of all, what is overhead? Overhead is an indirect expense. In the cost of production, you have a combination of direct costs and indirect costs. Direct costs or engineering cost here, both are direct, which can be traceable, which can be attributed to a product. But in the case of other expenses, to convert this material into the goods, we need to have some other overheads called manufacturing overheads or factory overheads. Manufacturing overhead or factory overheads, both are same. Overheads means indirect expenses. This indirect expenses can be indirect material, indirect labor, and factory expenses. Okay, and now the question is, when you want to give an estimation to a client, that client is ordering say 1,000 tables, a university is offering to buy 1,000 tables. Now it's asking what is the price, because university will ask at least 3-4 suppliers. One of them is you. This is you. If your price is competitive price, then you will win this order. Otherwise, what happens if you go with the rough calculations and quote say $25 per table, the others quoted $20 and $19, he will win this quotation. So while calculating the price, what you need to do is you have to be very careful that direct material, direct labor are easy to find out. Why? Because the moment you get this information, you will ask them the specifications about material and labor. But overheads are yours, your factory rent, insurance, etc., etc. You'll have to calculate overheads well. Calculation, it depends upon different approaches: actual costing, normal costing, okay, standard costing, extended normal costing, etc. Actual costing is not possible to put in the practice. Why? Because you'll have to literally wait and see the actual consumption, then only you can give the pricing. No, before you start producing the goods, you need to estimate the cost. How do you wait? Actually, your actual bills have to come, then you will include in the price, then you will tell the customer that this is the price of the goods. How can he give you order? You need to estimate the cost. Okay, so we use normal costing. In the normal costing, we allocate the overheads. We allocate the overheads based on budgeted indirect cost using an activity as a consumption. What is this activity? This activity can be direct labor hours, machine hours, number of the area, the square feet, etc. Now let me give you a complete picture here about normal costing, actual costing, and standard costing. Under normal costing, material anyway we can estimate, we use the actual cost of the material. Labor also can be traceable, we use actual cost of labor. Manufacturing overhead, variable, fixed, both are actual. So in other words, actual costing uses simply total actual cost divided by number of units produced. That will be the per unit cost. But customer does not wait until your actual bills come. So in practical, actual costing system is not used. Okay, when we ask a quotation, it is not understood that the customer is giving us the order, let me produce, then let me know the total cost, then I'll give you the price. No, you should be able to provide the price as the customer asks you. That's the reason why direct material, direct labor, there is no issue under nominal costing. You can find out the current market prices and you can add there. But manufacturing overhead, both variable and fixed, you need to assume based on the past experience. The assumption, the application, okay, the absorption, all the three words are same. So they are applied based on the past experience. Like if I spend say for example here, one particular product takes direct labor hours 10 at the rate of say $2 per hour. So the labor cost is going to be $20 per unit. Okay, and actual material cost, say material cost is say of we need around 100 kgs of material, each costing say 50 cents. This we found from the customer specifications. So $50 is the material cost. But what is the manufacturing overhead? So we estimate that per labor hour it is going to be $1.2. 10 machine labor hours times 1.2, so it is going to be $12. The fixed as well. So these two are assumed, applied, absorbed, different from the actual. Actuals will come to know later. Okay. In the standard costing system, what we do is we just put a standard. This should be the cost. This should be the cost. Okay. We do not consider the actuals and all. We put a standard that this should be the cost. So always in all the places it will be a should cost. Then should cost will be compared with the did cost. Did cost means what amount actually you paid. So should cost, did cost is to be compared to find out the variance. This we'll study in the next session, whether variance is a favorable variance or unfavorable variance, who is responsible for this, etc. in a variance analysis topic. So at the moment, actual costing uses only actual cost for giving the estimates, and normal costing assumes material, labor, actual, but overheads are applied. Applied means absorbed. Absorbed means assumed, presumed. Under standard costing, we use a predetermined costs. Extended normal costing. Extended normal costing, we estimate the for direct labor, direct material, and overheads. Unlike here, these are actual. No, here also we estimate. We apply based on the past experience. That is called extended normal costing. So under actual costing, we use direct material actual, direct labor actual, and overheads also actual. But in normal costing, we use direct material actual, okay, direct labor actual, but for overheads we calculate based on the past experience, predetermined overhead rate. What is predetermined overhead rate? Say for example, we want to calculate the predetermined overhead for the next month. We estimate all overheads, fixed and variable. Say for example, fixed. What is the rent, insurance, property taxes, depreciation, etc., etc. is say $500,000 for 1 month. Variable, repairs, maintenance, consumables, etc. is 300,000. The total is 800,000. $800,000 is the estimated overheads for one particular month. And say for example, our factory is a labor intensive industry. Labor intensive industry means most of the activities are carried out by human efforts, not automatic. Okay, so in that case, this is to be divided by what is the total direct labor hours in that month you are expecting to perform. Say for example, 80,000 labor hours. So $800,000 numerator divided by denominator level of activity is going to be direct labor hours. You need to estimate direct labor hours for the same month. Say we estimated it is 80,000 labor hours. So per labor hour it is going to be $10. This is a predetermined overhead rate in terms of labor hours. So if any work requires say 50 hours, 50 labor hours, the estimate can be like this. Direct material, we know what is the amount required, say $500. Direct labor also is traceable, say $300. Prime cost is $800. Then overheads we calculated that it takes 50 hours at the rate of 6 we paid here, and we take 50 hours here. What is a predetermined overhead rate? $10, so 500. So the cost of production will be 1,300. Then you can add your profit. So you come to know that before you are accepting the order, you are able to give a quotation. You can give an offer price based on 1300. So here these are all actuals, plus or minus it will remain same, but this is absorbed amount. The absorbed amount, absorbed overhead are to be compared with the actual overheads incurred. If this is 500 but actual overhead is say 600, okay, it is under absorbed, it is a loss to us. What does it mean? We charge to the customer 500 but we actually spent 600. It's a loss. $100, it's a loss to us. We have to charge it to our cost of goods sold. Our gross profit will decrease, net profit will decrease, retained earnings will decrease. But your absorbed amount is, say for example, $500, but you spent only $450. Over absorbed by $50. It's a profit. We should treat it as profit. Okay. So the predetermined overhead rate helps us to estimate the overheads based on some related activity. What is that related activity? Related activity can be your labor hours in the case of labor intensive industries, mission hours in the case of automated industries, and this volume, the direct labor hours or mission hours, etc., are calculated for a month or for a year, and this budgeted overhead also is calculated for a month or a year. Usually it is for a year because in one month we may get less hours, in another month we may get more hours because of holidays, because of month working days, etc. So it's an example like this company has a predetermined total budgeted overhead for 1 year. It is $100,000, and we can estimate, we can extract say 5,000 direct labor hours. So $20 per direct labor hour. So the activity level used by the company, in the previous example I used only direct labor hour here. Some companies may use different activity level, can be production volume, number of units that can be produced during the year, labor hours or labor cost in dollar amount, machine hours, purchase orders, machine setups, handling time, depending upon the the importance of the activity. Which activity is much important, that should be the denominator level. Now predetermined overhead rate for variable, for fixed, if the company wants to calculate different one, say 375,000 is the variable overhead rate, and we use say mission hours 50,000, and per mission hour it is going to be say 7.5. And for fixed, say for example we are using different activity level, that is mission hours or labor hours or whatever. Here I used again mission hours only, it is 12.6, or else you can use 375,000 plus 630 divided by 50. You will get to overhead per labor hour for mission hour. Say for example here we produced 4,300 and we calculated here 7.5 variable, fixed is 12.6, and 4,300 times 7.5, variable overhead should have been 32,250. This is overhead applied or absorbed or assumed, and we see that the actual overhead should be approximately plus or minus only this much. If it is beyond this, it's a loss. If it is less than this, it's a gain, it's a profit. Let's see. So we are charging this to a production process, work in process, 32,000. Variable manufacturing overhead applied is 32,250, and fixed overheads are 12.6 per mission hour, and we used actual 4,300, estimated an amount of 54,180, and the entry goes like this. Now if the actual overheads are different from applied, how to treat this? So in this, say we charged 86,430 to the production process by giving variable and fixed, but actual amount is say different. Actual amount is this. Yeah, compare. What happened here? We estimated an amount of 32,250, but we actually incurred 31,385. Customer has paid this much, but we spent only this much. So it's a profit. Applied overhead or absorbed overhead is greater than the actual amount. It is called over absorption. Listen carefully. Overabsorption. Overabsorption of overhead means absorbed overheads are greater than actual overheads. Customer paid this much, you estimated this much and charged to the customer, but you are able to actually spend only this much. It's a profit to you. 32,250 minus 31,385 is a profit. Let me show you in the case of fixed overheads, it's something different here as compared to variable. We absorbed a fixed overhead of 54,180 and charged to the customer. Later we came to know that it is not 54,180 or plus or minus, it is 55,970. We charged already the customer and we collected money, and we cannot go and ask the customer we under absorbed overhead and you'll have to pay me this much. No, it's a loss. This is called under absorption. When absorbed overhead is less than the actual overhead spent, it is called under absorption. Over absorption is a profit. Under absorption is a loss. Listen carefully. Over absorption is a profit and under absorption is a loss. Like this. It's a profit. 260, 220. Another example. So over applied by 40,000. It's a loss. No, it's a profit. Okay. So you should see this one. No? So if under applied or over applied is there, and how it is to be adjusted. Say for example, you produced 10,000 units, out of which 8,000 units are sold, 2,000 units are in the finished goods. This is sold, and 1,500 units are still there in work in progress, say for example, which are not part of this 10,000. If this under-absorbed or over-absorbed amount is not significant, it should be charged to, say, this is quantity. It is only, say, for example, $1,250. Under-absorbed or over-absorbed amount is this much. Do not think to charge this to cost of goods sold for this amount units, finished goods for this units, work in progress like this. No. It is a small amount. It can be charged to cost of goods sold, reduce your profit. But if it is 12,500, yes, don't charge it to cost of goods sold. This 12,500, what you need to do is, it should be charged to three components: cost of goods sold, ending inventory, and ending work in progress. Ending finished goods and ending work in progress in this ratio. That is 80 is to 20 is to 15. 8,000, 2,050. So this amount is to be charged to cost of goods sold, ending finished goods, and work in progress in this ratio. If any difference in under absorbed or over absorbed overheads, as compared to actual overheads, the absorbed overheads, the difference is immaterial, means not so significant. It can be charged to cost of goods sold. It's a small amount, say for example. But if it is material and good amount, it should be charged on pro rata basis to work in progress equivalent units, finished goods, cost of goods sold, based on the unit system or percentage system. Okay, very important, please. Okay, now while you calculating the denominator level, you arrived at, say for example, this amount, dollar amount of budgeted fixed overheads divided by budgeted labor hours. How do you calculate this labor hours is an issue. If you calculate, say for example, you have 25 laborers work for 24 hours a day, 30 days a month, 12 months. This is theoretical, which is not possible. All the 25 workers will not work for 24 hours. No. So practically means achievable, 25 laborers will work for 8 hours a day, will work for 25 days a month into 12. This is practical, but still you may have certain things like they have vacation, sick, etc., etc. So what we do is 25 times 8 hours, on an average we take 23 into 12 months. Even normal also, we estimate that some people due to accident or some strikes, some breakdown of machinery, still what we do is 25 times 8 times 23 working days on an average times 12, and total into say 80% we expect, and we include in the budgets. Theoretical capacity does not consider anything like vacation, like sick, accident, etc., etc. Practical capacity considers the number of hours here, number of days, etc. But normal capacity at which we can operate can be known, and expected capacity, from the normal capacity we expect, the some percentage, and we use that in the predetermined overhead calculation. If you use theoretical capacity, the denominator is too high and the predetermined overhead rate will be too low. Customer will be happy because you are charging him less. Are you getting me? Say for example, if you calculate like this, say $800,000 is the total amount of budgeted overheads, and budgeted denominator level will be 25 into 24 into 30 into 12. So it is 216,000. 216,000. So per labor hour it is going to be 800,000 divided by 216,000 will give you 33.7. 3.7. Say for example, there is a customer who is asking per unit cost to give you asking you estimate. Direct material required is 100 and 80 is the direct labor. Manufacturing overhead is estimated based on the labor hours. We need 5 labor hours times 15 labor hours times say 3.74 as per the calculation. Okay, 3.7 into 15. We understood that around $55 is the cost. So 55, 180, 235. Based on this, say you gave a quotation for $325, expecting a profit of $90. But here this is calculated using theoretical capacity, which is not possible. So product cost has become cheaper here. See, because it's only 55. Let me calculate here what happens. Same $800,000 estimated overheads divided by estimated denominator level is going to be 25 times 8 hours only per day times 25 days per month into 12. The denominator level is 60,000. Oh my god, where is 216? Where is 800,000 divided by 60,000 will give you 13.33. Now see, this will not be 55, it is going to be into 15. It is $200 as per my calculation. So 100 plus 80, 180 plus 2, 380. You accepted a selling price of 320. So it is little bit costlier here, practical capacity. Now let me show you this. 800,000 divided by, they work for only 25 into 8 into 23 days only into 12 months. This is 55,200. So 80,000 divided by 55,200 will give you 800,000 divided by 55,200 will give you 14.5 into 15 hours requirement, that is 217, not 200 also, it is 217. See, again $17 increase, 17 plus 217 plus 180. Yeah, it is going to be 300 and 180 plus 217, 397. How can you accept 325 with a profit of $90? Remember? And what about this 800,000, 55,200, from which we are expecting only 80% occupancy into 80%, that is 44,160. 80% of 55,200. The price will increase now. Rate will increase. 800,000 divided by 44,160 will give you $18. Oh my god, who gave that quotation? Into $15, 15 hours. So it is going to be not 217, it is 271. number reversed, plus 180. It is going to be 451. Our cost is 451. We are giving quotation for 325 with no profit, but there is a heavy loss of 325 is 126, 126.7 is a loss, 127 is a loss. Okay, we can't give that way. So the moment you use the capacities here, the price per unit will increase. So you'll have to be very careful. We never give this to. We either use normal capacity if you can effectively work. Otherwise, you need to find out expected capacity level in the denominator. See, as I told you that theoretical capacity disregards machinery breakdown, but in practical it is not possible. Holiday downtime, yes, of course we have to give holiday down, that's all important. So what happens when you do not count all this? You will have a lowest product cost. Lowest product cost I explained you with my detailed calculations. When you estimate lowest product cost, customer is happy, but at the end of the day your company will incur losses. Practical capacity, consider startup time, downtime, etc. But still you will have some under applied overhead. It will give you lower product cost. Not lowest, but lower. That's the reason why what you need to use is normal capacity based on the historical production level. Estimate the future production level. You'll have to see, identify some fluctuations. So from this you will find out attainable level of activity. After calculating normal capacity, you will consider that 80% can be attained, 90% can be attained with a close supervision. That should be used. And that is going to be a little higher the production cost. Exactly, this will match in fact, and even after that if you have any issues, so what you need to do is you will have to find out that and use expected capacity production calculation. This will be giving you highest product cost. This and all I explained you with the numbers clearly. You can recheck once again. Yeah, so capacity level, theoretical capacity, it will give you lowest product cost, which is in fact very dangerous to the company. Low product cost, normal higher product cost, and expected highest product cost. So you may calculate the overheads based on the normal capacity also, but if expected capacity is same, okay, expected capacity with the normal capacity, you can do that. But if the normal capacity is greater than the expected capacity, okay, you will have little higher but not highest. So if this is different, then you should use 80% of this or 90% of this or 75% of this expected, so that it will give you highest product cost. Or else you can use normal capacity if you can achieve it. This is the end of the session on overhead allocation. What we discussed so far was like the overhead allocation using application of overheads. In that you may have under application, under applied overhead, or over applied overhead. Under applied overhead means you applied overheads less, absorbed amount is less than the actual amount. So it is a loss and it will have debit balance. Here over absorbed overhead means absorbed overheads are greater than the actual overheads. It is a profit and it will have credit balance. Profits show credit balance. Now whether this absorbed, under absorbed, or over absorbed should be charged to either profit and loss account or not. So that depends upon materiality of the amount. If it is immaterial, it should be charged to cost of goods sold. This will have an impact on your net profit. But if it is material, you need to check what is the cost of goods sold and what is the finished goods, ending finished goods, and what is the value of cost of goods sold. Based on these percentages, you should absorb the under-absorbed overhead or over-absorbed overhead. This is about absorption of overheads. And the second point what we discussed was the overheads, calculation of predetermined overhead. Calculation of predetermined overhead, you budget the overheads for one particular period. It can be either for a year or month, divided by the quantity. The quantity can be labor hours, machine hours, production quantity, etc. But most of the companies either use direct labor hours or machine hours. If it is a labor intensive industry, labor hours, direct labor hours. If it is an automated industry, machine hours, number of machine hours for this period. If these overheads are estimated for 1 year, direct labor hours can be derived in 1 year, or machine hours can be derived 1 year. And whether it is direct labor or machine hours, we have capacity levels. It is theoretical capacity, okay, practical capacity, normal capacity, and expected capacity. Normal capacity usually is to be used, but if normal capacity exceeds the expected capacity, we should use expected capacity. And what do we understand here? Theoretical capacity will give you lowest cost of production. It gives you lower cost of production. Okay, normal capacity gives higher capacity, but expected level will give you highest. It is suggested always to use expected capacity if it is different from normal capacity in the calculation of predetermined overheads. That's all for now, and we'll see in the next session with the service department overhead allocation. Thank you so much and have a good time.